Welcome to Easy Peasy Affordable Investing Strategies. This is a weekly workshop for everyday people who are looking for set it and forget it strategies. This is for busy entrepreneurs who don't have a lot of time, energy, effort, or cash, but they are interested in building a better financial future for their family. If this is you, welcome. Banks invest your money, insurance companies invest your money, the government invests your money. Everybody you pay bills to invest your money. You are the only person scared to invest your money. It's time that you learn how to invest. It's time that you take charge of your family's financial future. Welcome to Easy Peasy Affordable Investing Strategies. My name is Nancy Gaskins and I'll be your host. Does the word invest or just the thought of investing scare you? If you're like most people, the answer would be yes. The fear of losing money, the fear of not knowing what to do. In fact, it stymies so many people that they never ever even get started. They never get in the game. This is one of the major reasons why I created the Easy Peasy Affordable Investing Strategies program. And the way that we're going to do this, it's going to be sectioned out into three parts. The first part is going to be game plan examples. This is going to be where I show you some affordable options where you can create these different funds to fund your lifestyle goals for now as well as in the future. For example, a perpetual vacation, birthday, and Christmas fund. You might be wanting to buy a new car, so you're looking for a fund to fund your car payments. You may be wanting to fund a college fund for your grandchildren or your children. You may have a church or a nonprofit, or maybe you want to create your own philanthropic organization. You can set those up. Some of you may just be needing to add a little extra cash to your budget to help you make ends meet each month. Some might be looking for income replacement. You might be wanting to quit your job, or maybe you need some extra cash. Others are looking for retirement. So this is where I will be showing you some very easy, simple to understand ways that we can set this up for you to achieve your financial goals. We also will be talking about how you should be fighting inflation and how to calculate annual raises to see if you really in fact did get an annual raise. You might be surprised, the majority of you are probably calculating your annual income wrong. Usually when I do this exercise, people are shocked that they have been calculating it wrong for many, many years. And trust me, it does make a difference, as well as inflation. Inflation can really take a bite out of your personal finances if you don't do that correctly. The second section is we're going to be exploring investment options that are available worldwide. Why? Well, you need to know what's out there. You need to know the historical averages. You need to know how volatile the market is so that when it gets time for you to set up your game plan, you can find some investment vehicles that you feel comfortable with. This is not a one size fits all for everyone. For example, somebody may feel very comfortable with real estate and totally not comfortable with the stock market. So we want to make sure that you can talk intelligently and you know the historical averages, because some of these will be more conducive for you achieving your goals on time than others. Last but not least, I'm going to go over PIG membership. This is our Passive Income Generators Wealth Builders Club, and I'm going to give you an overview on that to see if this is something that you might feel like this is a good fit for you sometime in the future. Feel free to break this into three different sections and listen to it at your leisure, or go ahead and just listen to it all at one time and then maybe go back and review. Is your pig starving? Most people I talk to would say, yes, starving to death. One of the things that I noticed, and one of the reasons why I created the passive income generators, was I was seeing all these people all over the world checking out different things, and a lot of them were scams. and they were embarrassed. And a lot of times people will invest their money in different things, and after they lose one time, then they put their tail between their legs and they never want to invest in anything ever again because it's just scary. So what we did was we come together as a group, and if you haven't noticed, pennies turn into nickels, dimes, and quarters turns into dollars, and dollars turns into hundreds, and hundreds turns into thousands, and thousands turn into millions. So I tell everybody, it doesn't matter how much money you have or don't have. You've got to start somewhere, right? So if all you have is penny, nickels, dimes, and quarters, that's okay. Start there. Okay, so I don't want you to be scared and I don't want you to be fearful. Again, it's start where you are. And as you go through this training with me, you're going to uncover some ways to save money, to make more money, and all of those things that will help you add to your bottom line. And you have to make it a priority. You have to pay yourself first. Is your family's financial future worth a little sacrifice right now? And I'm not talking big sacrifices. Back in the day, I know it was a big deal that everybody told you you had to invest 20, 30 years so that you could retire. Well, that was back in the day. Most of us don't have 20 or 30 years, or, we're getting older and something has happened and we may not even be living that long. And we don't want to be, we want our golden years to be golden. So we're looking for other alternatives. We're looking for other options. If so, this is the right place for you. Stephen Covey came up with a book, and one of his first rules was you always want to begin with the end in mind. So, in order to do that, you've got to figure out where do you want to be. There's a reason why your front windshield is larger than your rear view mirror. It's because what behind you is not nearly as important as what's in front of you. So forget about your mistakes. Forget about all the things that you did with your money that maybe might not have been so smart. Forget about the problems that you faced with your money. Today's a brand new day. So let's start where we are. Let's start today. Figure out where it is that you want to be in your future. Next step is we're going to create a financial report card for you. And this gets a lot of people. Okay? They don't want to face the truth about where they are financially. We're going to look at your credit, and this will be an individual thing for you to do on your own, not have people in your business, so you can relax a little bit. But you want to figure out how much assets you have, what you own, how much your liabilities is, and that includes all those nasty little dirty little credit cards and all that debt that you've racked up. You subtract those two, what you own minus what you owe, and that's going to give you a nice little tidy number called net worth. Some of you may be surprised to find that you're negative. If you've got a lot of credit card debt in particular and no assets to back that up, chances are you're going to be in the hole. You're going to be negative. The main thing is we need to see where you are today so that we can put you on a plan to improve that for your future. Next step is we'll create a couple of different roadmaps on how you can get there. Number 4 is extremely important. You need an accountability partner. Most people take advice from people who don't have money. People take relationship advice from people who've been divorced 10 times. Guys, that's not the right way to do it. You need to be around people who are where you want to be or are on the trajectory on that path. And you need to be learning from those people. I'm not trying to be disrespectful, but don't take money advice from people who don't have money. Yes, they may be meaning well, and they may have had, some bad experiences and things like that. Yes, you can take that into account. But the bottom line is you need to put yourself in a group of what I call eagles. Eagles don't hang out with turkeys, chickens, and vultures. Eagles soar above that. So you need to be around people who's going to inspire you, who's going to encourage you to rise higher, go further, faster. People in our group, they want to do really great things with their lives. It's not just about money for money's sake. We're wanting to make a positive impact on the world, on our neighborhoods, on our families. We're looking at generational wealth. We're not talking about gee, I want to make $100,000 every year for eternity, not ever do anything great with our money. So having an accountability partner is crucial because they're going to hold you to a standard. And chances are, if you've ever had like a New Year's resolution, let's just say to go to the gym. If you was just going to the gym by yourself, chances are you're going to probably miss after the first, 30 days, your goal's probably gone. But if you set yourself up with an accountability partner, which means you've got a trainer or somebody that you're going to meet at the gym every morning at 6:30, chances are you're going to go and they're going to hold you accountable. That's what I'm talking about here. Next is very important. Main thing is you just need to get started. Don't worry about where you are. Again, don't worry about if you've got pennies, nickels, dimes, or quarters, or whether you have $5,000, $10,000, $20,000. It doesn't matter. The main thing is if you've not started, you have to have a starting place. One day at a time, one step at a time. And Dave Ramsey, I'm a huge Dave Ramsey fan and financial coordinator, and he calls it baby steps. That's all you got to do is you got to start somewhere. Start with those baby steps. As I stated previously, the first step is to begin with the end in mind. In order to do that, you've got to figure out what are your financial goals. What are the most pressing issues that you have going on right now? So we need to make a list of all your financial goals, and then we need to prioritize those. So what's most important right now? Do you need to get out of debt? Is that strangling you? Do you need some extra cash just to help make ends meet? Or are you already over that hurdle and maybe you're looking to fund your future? You want to set up the perpetual annual vacation, birthday, and Christmas funds. Perhaps you're looking retirement. You would like to retire sooner rather than later. So again, this is the hardest part. It doesn't seem like it because when I'm saying it, it sounds so easy, but you would be so surprised at how many people have never sat down and really wrote down and figured out what their financial goals are. They keep it rolling around in their head. And one thing that you're going to learn is you got to write it down to make it happen. If it's just out there in your mind, it's a wish. That's what it is. It's never going to happen. But in order for you to achieve your goals, your financial goals, you have to get everybody on the same page. You have to make a list, and then we have to prioritize those. So I'm going to be going over a couple of examples in the next few slides that I think is going to get you really excited. The first one is really popular for most people. They just can't seem to wrap their heads around it, although the idea sure is enticing for them. And that is a perpetual vacation fund. Doing a little research, and you can use Google just like I did, we find out that a typical family of four in the USA spends about $5,000 a year on their vacation fund. Many of them charge it. Many of them are in debt, and it takes them years to pay that sucker off, especially with all the interest and all of that that comes along with that, besides the stress of having to make that payment every month. So let me set this up. Imagine if you set up an account one time and it was designated as your vacation fund. And every year, just like clockwork, you would be able to take out $5,000 and spend it any way you like on vacation. It doesn't matter if you want to spend it on flight tickets, on hotels, on the food. I'm talking the whole shebang, everything that you could think of. Now, it doesn't have to be 5,000, but since that's the average, that's what I decided to use for our example here. Well, using one of the platforms that we have been using for quite some time, we've been averaging about 3% a week, about 2.85 to 3% every single week on our money. So this is the example that I'm going to be using to show you just how easy it would be to set up a perpetual vacation fund for your family. How much would it cost? Using our example, you would need about $1,600 in an account that would be churning off and compounded all year long And then at the end of 12 months, you would be able to pull out $5,000, use that for vacation, keeping $1,600 in the account. Make sense? You need $1,600 to put into an account all year long so that you would get $5,000 out and you would still have enough in the account left over that you could fund that vacation fund the following year. Sound hard? Well, I don't have $1,600. That's okay. I'm going to show you how to do it. Okay, this is one of the worksheets, and I don't want you to get bogged down by these numbers and get scared. This is just a screenshot that I took using a compound calculator that I'm going to show each and every one of y'all how to use. It's very simple. You just plug in numbers and it does all the heavy lifting for you, so there's nothing really that you have to know, no magic formulas or anything like that. So let's first begin with this $5,000 perpetual vacation fund. If you were to set aside enough money every month so that you would have $5,000 a year available each month, you would have to set aside $416.66 every single month, and that would get you to $5,000. Okay? And once you spent the $5,000, you would have to start all over again, right? So our game plans, we want you to set up a fund so that you set it up one time, and then every year the earnings off of that account will pay for your vacation, and you'll have enough left over to fund the next year's vacation. So let's look at this 12-month plan. You start out with $1,600 in the account, and there is a $25 a month service charge that comes out of your account every single month. So that's the second column there. And then the first one shows all the way down to month 12. And if you'll notice, down at the bottom of the far right corner, the balance at the end of 12 months, and this is hypothetical. Of course, there's no guarantees or anything like that, but this is just a hypothetical example. You would end up with $6,773.51. At this point, you would make a withdrawal of $5,000. That will leave you about $1,773.51 in that account. And how much do you need on average so that you'll have $5,000 every year? Using this example, you would need about $1,600. So that is the math done for you. If you had $1,600 that you could invest today in this account, and in 12 months it would churn off enough for you to have $5,000 and enough for you to have $1,600 left in the account each year to fund the next year. Okay? So your goal for a perpetual vacation fund of $5,000 would be you need $1,600 in the account for a 12-month plan. Okay? But what if you don't have $1,600? I'm going to show you how to deal with that in the next slide. Before we go on to the next slide, let me ask you a question. Would you rather have to put away and save $416.66 every single month for the rest of your life to fund a vacation, or put aside $1,600 one time only and fund vacations for the rest of your life? Think about that. $416, that's like 4 months worth. You can choose to do that for the rest of your life and pay $416.66, or set up a fund, do it one time. The same thing goes with car payments. Oh my goodness, everybody tells me it's just normal. Everybody's got a car payment. Well, you don't have to have a car payment. That's for another time, but I'm just saying you can set up funds where it takes care of all of that. So again, think about this: $1,600 one time, or $416 a month for the rest of your life. You choose. The next couple of slides, I'm going to show you a couple of different scenarios, a couple of different roadmaps that can still get you to where you need to be, but you may not have $1,600. So I'm going to show you how to get there in the least amount of time. So the first one, this would be a 2-year plan. Okay? Now remember, you need $1,600 in the account. So the first way that you could get your $1,600 is, let's say that you have $325 available and you could afford to put $1 a day or $30 a month into the account. So you look at column 2, it shows your $30 going in and your $25 service charge coming out. So that at the end of 12 months, the last column, the blue column, it says balance. In that account, you would have $1,645.12. And remember, you need $1,600 to fund your 12-month vacation account. So it would take you 12 months to get to $1,600. And then from that point, it would take you 12 more months to get your first vacation. Make sense? So that's your 2-year plan, starting with $325 and adding $30 a month. But what if you don't have $325? Going to find out in the next slide. Roadmap number 3. This is for those who have $99 and they could add $1 a day or $30 a month to the account. Okay? You start with 99 and you add $30 to your account. Now, go down the right side, and what you're looking for is how much money. You need $1,600, right? So if you go down, you will see at month 8, you would have $325.92 in your account. Does that ring a bell, that number from the previous slide? So it would take you 8 months to get to $325.92. Then you compound that for 12 months to get you to your $1,600. And then you need 1 year at $1,600 to get you to your $6,773, so you can withdraw $5,000 a year, and that's going to give you your $1,773 left in the account. So how many months would this one take? 8 months to get to $325, 12 months to get to $1,600, 12 months to get to the $6,773. So this one would be 32 months. Again, don't let it be discouraging. You may find other ways that you can add to it. It might not take you 32 months. You might have more than that you can add to it. Or if you get a windfall, or you could sell some things. There's a million different ways that you can do this in a shorter period of time. But I'm just trying to show you some options. So let's look at a little bit faster route in the next slide. Before we go on to the next slide, something that I need to take into consideration here. This one, you're adding $30 a month for 8 months, and then you stop putting the additional $30 in. That's your 32-month plan. However, if you continued to add $30 every single month, you would get to your goal way faster. So I'm just saying, these are options. You could put in $30 a month for 8 months and then don't put in any more and just let the compounding take effect. Or you can continuously add $30 a month throughout the whole thing and chop it down to even less time needed to achieve your financial goal. Roadmap 4 is you have $99, but you can add $50 a month instead of $30. So you got a little bit more discretionary income. You don't have it up front, but you believe that you could come up with $50 a month. Note that at month 5, you're going to have $343.84. That's at month 5. So then you're going to compound that for 12 months. That's going to get you to your $1,600. and then compound that for 12 months. It's going to get you to 6,773. This one is 29 months. So this one is a little shorter time frame. And again, if you stop making your $50 a month payments, that's the 29 months. But if you continue making $50 a month payments into the account, you're going to get there a whole lot faster. Okay, keep in mind those game plans was to come up with an account that could provide you with $5,000 on an annual basis. Whether you use it for vacation, whether you use it for Christmas, doesn't matter what you want to use it for. That just kind of gives you an idea. Okay, you would need about $1,600 in the account so that you could have $5,000 at the end of the year, and you would still have enough in the account that it could continually grow and give you $5,000 a year into perpetuity, which means basically forever. Okay? But what if you're looking for a little bit more? What if you're looking for some income replacement strategies? You want to replace your income. First of all, let's do a little research and kind of show you what you're up against here, okay? I want to give you a little bit of information here. Not that you have to memorize it, but you need to be aware. You need to have these tools in your toolbox so that you can see how you compare your family's finances against others in the U.S. And I'm in the U.S., which is why I'm using U.S. dollars here, okay? So minimum wage in the USA right now is at $7.25 an hour. The current inflation rate, which means how high the price of goods and services is this year, it's at 8.2%. A normal year was about 3% a year. And what I mean by that is when you go to the grocery store, your groceries are higher, your electricity is higher, your cars are costing more, your homes are costing more. All of that stuff is inflation. So typically over the course of a year, the normal rate would be about 3% a year. When we calculate from 1960 all the way to 2021, the average right now is about 3.8%. So when you go calculating how much raise you got from your employer, if you did not get more than 3.8% a year increase, you're not even keeping your head above water. You cannot pay for the same goods and services as you did last year, so you really did not get a raise. If you did not get at least 3.8%, you did not get a raise. You would need something like 5%, 6% in order to justify that you would be able to buy the same amount of milk, eggs, butter, and soda that you did last year. Make sense? Okay, those are your numbers. Now, another area that I see people getting confused is how they calculate their salary and how they calculate their income. Most people will take their weekly amount, multiply it by 4 to come up with a monthly amount. That is not the correct way to calculate how much income you're earning. So I want you to do it that way, and then I want you to do it the correct way, because so many people really foul up when they're negotiating their salary or when they're putting their income down on financial statements. So here's the calculation down here on the bottom of this slide. You take your dollar amount per hour times 40 hours a week times 52 weeks per year. That will give you your annual income. $7.25 an hour times 40 hours a week times 52 weeks per year. That's going to give you your annual income. To get your monthly income, you would take that number and divide it by 12. Okay, some of you may get paid once a month, some of you may get paid twice a month. How do you calculate that? You take your annual amount and you divide it by 26 if you get paid every other week. It's very important. How important? Let me just give you an example. If you're at $10 an hour, 10 times 40, that's $400 a week. If you had said, how much do you make a month? And you said 400 times 4 is $1,600, you'd be wrong. What you would need to do is you would take your $10 an hour times 40 hours a week times 52 weeks per year. Then you would divide that by 12. And guess what the number comes out to be? 1,733, not 1,600. And you're thinking, well, that's not very much. Well, yes, it is. It's about $133 a month. Mix that in with inflation, you got a recipe for disaster when you're trying to calculate your salary. You're losing money. You're losing about $133 a month. The other thing that I wanted to bring up is we're at the end of the year, so people are having their end of year reviews. Like I said, from 1960 to 1921, the average has been about 3.8%. This year, because of our economy and COVID and everything else, we have an extraordinarily high inflation rate. When I calculated this the other day, and I'm not sure if it's still correct, but it was 8.2%. So when you go in to get your raise this year, if your employer doesn't give you at least 8.2%, you cannot keep your same standard of living. You're losing money. Chances are they're not going to be able to afford that. So you're going to be in a pickle. And you can already see this because people are complaining about the gas at the pump, the groceries, and all of that stuff is just eating them out of house and home because their wages are not in alignment with the current inflation rate. So if you're a government employee, civil service, or military, or something like that, when you're looking at how much you're going to get increase, there are Social Security, and they're talking like it's historic raise this coming year, 2023. You might take a look at this and see just how great it is. Because if it's not 8.2%, guess what? You're losing money. Inflation is going to eat your lunch if you're not careful. So be very careful when you're calculating your salary and when you're trying to calculate your future items, just like that $5,000 vacation. It's $5,000 this year, but if you add inflation 3.8% next year, it's going to be 5,000 times 3.8%. The next year it's going to be even higher and even higher. So if you don't calculate inflation into that, you're going to be again eroding your purchasing power. In this example, we're going to calculate $10 an hour. $10 an hour times 40 hours a week times 52 weeks per year. And what I did in these charts that I want you to see is in that first line where it says year zero, in the balance column, the blue column, it says $20,800. Okay? That's how much $10 an hour equates to on an annual basis. But what I want you to look at is each year, as you go down that chart from top to bottom, you're going to see that $20,800 starts increasing. And why is it increasing? It's because you have inflation happening. The price of goods and services continues to go up every single year. And it goes up on average 3.8%. And before I had calculated this, I had just used 3% on this chart. So just know that the numbers are actually larger than this. So if you wanted to know next year, in order to get a raise, you would need to be making $21,590.40 just to break even. So you would need more than that if you wanted to get truly what's called a raise from your employer. Okay? And if you wanted to see what that would be worth in 10 years, go down 10, you would be needing to make $30,202.08 just to keep up with and have the same standard of living as you do today. Now, most people, they want to be making more money. They want their standard of living to be higher. And the reason that I'm showing you these charts is, let's just say if you wanted to retire today, or you wanted to replace your income and you didn't want to work for 20 years. If you had the standard of living that you wanted, how would you calculate how much money that you would need? you would go down that right side of that balance and every year take inflation into consideration. You would add all those numbers up and you would come up with a grand total, and that would be your bottom line number. Another fallacy that people do, and I worked in the financial services industry for quite some time, and it drove me crazy, is a lot of people and financial planners will tell you that you're not going to be spending as much during your retirement years as you are right now. Well, in some instances that may be true, but personally, I want my golden years to be golden. I want to do a lot of traveling. There's a lot of things, and all that's going to cost money. So make sure that you're taking advice from somebody who really listens to you and finds out what your goals are for your retirement or your golden years. Because most of the time, in my scenarios working with people, is they're wanting more money, not less money, to live on during their retirement years. Okay? So that's $10 an hour. So let's move up a little bit. Okay, this example is for those of you who be making $20 an hour. $20 an hour times 40 hours a week times 52 weeks a year, that's putting you at about $41,600. Again, using 3% a year, go down the right side there, and that's what you would need to be increasing your wage every year to keep your same standard of living. Again, not any better. This is just to keep your purchasing power, what you were able to afford this year, in alignment with what you can afford next year. Make sense? Okay, here's the biggie. The average household income in the USA right now, and that's based on a Google search, was $70,784 in 2021. That's on average. Check yours against the average to see how you stack up. Again, our current inflation rate, our economy is in a terrible situation. We're at 8.2 when the normal was 3% a year, but adding in these last couple of years of volatility, right now it's running 3.8%. But as you can see, this year it's 8.2. So it's, what is that? 7.4. It's, goodness gracious, it's way more than double what it normally is just right now, 8.2%. So let's look and see what that would equate to. Next year, if you wanted to get a real raise, you would need to be making more than 73,511, because that's what it would take to buy the same amount of goods and services. If you don't think it matters, go down through there in 20 years. Look what you would have to make in 20 years just to stay current with your current lifestyle. $150,000. That inflation can erode your lifestyle and your ability to take care of yourself in the future. So it's very, very important that you factor in inflation when you're trying to calculate how much money you're going to need. Ask your grandparents, ask your parents how much a car used to cost. I mean, I can remember, and I'm 59 years old, and I can remember one of our first houses that we bought, 3-bedroom, 2-bath home in Oklahoma, and we paid $33,800 for that house. And that house is worth several hundred thousand dollars now. It's just absolutely crazy how it's increased in price. So let's take a look. 5 years, 10 years, and 20 years. Like I said, that same 70,000, you would have to make 150,000 just to stay equal. Okay, here comes the fun part. Let's say that you're an average family in America, and your average household income is $70,784, and you wanted to retire right now, and you wanted that income to last you at least 20 years. How much money would you need? Well, you're going to assume 20 years and 3% inflation, but again, we're going to redo the calculation using 3.8, but for this particular example, let's say 3% inflation. Over on the last column that's in blue, you would see that I've used 3% inflation, and every year it's listed how much income that I would need. So you go all the way down to the bottom, and I added up all of those numbers, and that means that I would need $2.2 million to fund a 20-year retirement if I wanted to stay at about the same income level and purchasing power that I have today. That's not any more or any less. That's about to stay right on par with what I've got right now. And I also did an average from all the way down for the 20 years. And on average, that's about $105,000 a year. So that would be my number. Okay, that would be my number that I would want to shoot for. Some of you may be shaking your head thinking there is no way that I can come up with $2.2 million to fund a retirement. Well, what if I told you that we could put a game plan together that you could do it in 5 years or less? Would that be something of interest? For most of us, we'd probably say, heck yeah, right? I told you my group, we're on a 5-year plan, okay? Some of you are going to be able to do it in less than that. Does it seem too good to be true? Absolutely, but there's never been a better time right now with all of the things going on in this world. We've got the internet, so we can access opportunities that we've never had at our disposal before. So the main thing is getting these numbers together to figure out how much do you need. You want to replace your income. You want a vacation fund. You want a Christmas fund. You want this. You want that. You know, you want to set up a charity for your family, a foundation or something like that. The main thing is you need to get crystal clear on what that's going to look like. That's going to be the hardest part. The money piece is easy. It's just the hardest part is sitting down to figure out what exactly you want this to look like. Okay? All right, I'm ready to get started. How about you? Another thing that I want to share with you right here, too, there's two numbers down here. One is the average and one is the totals. Some people opt to, they say, well, I'm not too worried about getting $2.2 million. I don't need that lump sum. Well, what do I really need? Well, if you look at that average, all your investments, if you just want to have investments setting aside, they need to be churning off on average about $105,000 a year. Also take into consideration, this does not take taxes into consideration or anything else. This is just flat out gross income, if you will. So taxes are not a consideration. Some of you thought $1 million was a lot of money. To some, it still might be, but when you look at this, $2 million is what you need to fund an annual household average right now of $70,784. And I don't know about you, I don't want to be average. I want to be well above average. I want to have a great lifestyle, but this is a starting point. So this will kind of get you in the ballpark. So just want to keep that in mind. $2.2 million is what you would need to fund it. But another alternative would be you would need enough assets or investments churning off at least $105,000 a year to support you through a 20-year retirement. Most of you probably are going to not believe this number. You saw that it took about $1,600 in an account to churn off $5,000 a year for your annual vacation fund. Well, if you want to replace your income in 5 years or less, using our hypothetical example, remember you need about $2.2 million, right? So if you deposited $5,000 and you had that $25 a month going out of your account each year, 25 times 12 is 300 bucks. On the right side, let's look what your money, how your money could possibly grow over the next 5 years. 5,000, 20,000, 89,000. Notice it doesn't get really too exciting until year 3. And then compounding, you probably heard the word, you know, compounding is the seventh wonder of the world. It is. People do not realize how powerful compounding can be. You can compound monthly, quarterly, daily, annually. There's a million different ways that you can compound. This is based on weekly compounding. Look what happens at year 4. $1.6 million. But at year 5, you're at $7.1 million. So what you could possibly do is you could pull out $2.2 million because that's what you're going to need, put it in something else, or and keep the rest of it going in your investment accounts and set up a family legacy account. Or you could just pull out what you needed each year for 20 years and let it keep on going. You know, it really depends on you, what you want to do with your money at that point. One of the things that I plan on doing with mine is once I get mine built up, I'm going to buy real estate with my portion, not all of it, and then keep the remainder in these accounts growing for my family's legacy. And you can choose to do whatever it is that you want to do. It's just me. I happen to love real estate, and so that's one of the strategies that I'm going to be using with mine. So again, $5,000. That doesn't sound too daunting, does it? $5,000 for the potential to have your whole income replaced in 5 years or less. What's going to happen in 5 years if you don't do anything? Right? You're going to still be in the same place. But what if? What if? I'm trying to show you the possibilities. $5,000, folks, is not a lot of money. You may think it is, but it's not. And I'm going to show you how you can get to $5,000 in the next couple of slides.
Something else that I want to bring to your attention. You know, you only needed 2.2 million. So if you look at year 4, it's 1.6 million, but at year 5, it's 7 million. And so I ran the numbers, did the little calculations just to see how much longer that you would actually need. And it came out to about 4 years and 3 months to hit 2.2 million. So the rest of that is just gravy. So 4 years, 3 months, $5,000. Not bad.
This is another game plan that can show you how to get there even faster. If you had $10,000 in an account, it would take you 4 years. So it's going to shave off a year. But look what happens between years 4 and 5. You go from 3.3 million all the way up to $14 million if you had $10,000 in your investment accounts. Again, no guarantees of income are expressed or implied. I'm just showing you a game plan strategy that some of us are using to create wealth for us and our families. So this one is starting at $10,000.
Also keep in mind here, this one, I calculated it exactly just to kind of see what it was, because again, you need 2.2 million. And at the end of year 4, it was 3.3 million. So you're over a million. And so actually you could reach your goal 3 years, 9 months. So not quite 4 years. Another thing to keep in mind on these examples is you're not adding any to them. So if you started out with 10,000 or started out with 5,000 and you added that 30, 50, 100 or 25, whatever you can afford to add to it, your time frame is going to shrink dramatically because of the compounding.
Remember, you've already got a roadmap to generate an extra $5,000 per year into perpetuity. That means year after year. This is a roadmap on how you can generate and withdraw $10,000 per year at the end of the year. You would start with $3,200, and at the end of the year, at the end of 12 months, you would withdraw $10,000 in a lump sum, and that would leave you with $4,882 in the account so that it could work and compound to your benefit the following year to generate another $10,000 a year. See, this is not so hard. You getting the hang of it yet?
And something that I noticed here, I don't have the $25 service fee in here. So I apologize for that. I'll have to go back and redo this slide. But anyways, basically you get the same gist.
So if you remember, that first example was you needed $5,000 in an account. Well, what if you don't have $5,000? This example, you start with 1,500. And 1,500 at the end of 12 months, letting it compound, taking out your $25 a month, you would have your $5,827.89. That's starting at $1,500. So if you could scrape together $1,500 in 12 months, 1 year only, you would have enough to set up your income replacement strategy.
And this
Think
slide,
that's doable? Maybe you don't have $1,500. I'm going to show you how to get there.
this slide right here is another cash flow roadmap. This is showing you how to generate and withdraw $1,200 a month. You would start at $10,000 and you would withdraw $1,200 every single month and then leave the remainder in there to compound. And you would see at the end of 5 years, you would still have $2.6 million in there. So if you were looking at a way to generate a little extra income and grow the account as well, you could do that. You just simply pull out weekly, quarterly, whatever the amount is. You can play with the compound calculator to kind of figure it out and see how the numbers play out for you. But this would be an easy way for you to add an extra $1,200 a month to your income right now. And I don't know about you, but most of us would enjoy having an extra $1,000, $1,200 lying around.
The whole point of the slides that I've been showing you is to show you that it is indeed possible. Many people think that it requires, thousands upon thousands of dollars for you to plan for your financial future. I'm not saying that wasn't the case 30, 40 years ago, but it certainly is not the case today. It takes far less money than what you think to get started, but the most important piece is in white letters across this screen right now. The main thing is you've got to start today. If you didn't start yesterday, the next best date to start is today. So I want to encourage you again. I don't care if it's pennies, nickels, dimes, or quarters that you have, you need to start thinking about your family's financial future and your family's financial legacy that you want to leave behind for them. Like I mentioned in the beginning, the first thing to do is really start brainstorming and think about what it is you want your life to look like. And a lot of this may seem like it's lifestyle choices, but you have to start somewhere. And then
And so,
like I mentioned in the beginning, the first thing to do is really.
and so the part two of this is we need to start exploring all your options. We need to find out what's going on out there in the global marketplace. What are your options? Many of you don't have a clue. You've heard about some investment vehicles. You really don't understand some of them. You're scared of some of them. Some of them you think maybe not for you. Some might be. Some you think you don't even qualify for. So we're going to be exploring all of those options to give you a really good feel of what's available out there.
The next couple of slides, I want to go over what's available in the marketplace today. Basically, these are going to be your traditional investment vehicles that we're going to go over. We're going to discuss the historical averages just to give you a really good feel of what's available so that you can talk intelligently, or you can know if somebody's talking to you, whether they know what they're talking about or not. Okay, you ready to get started? Let's do it. The first type of investment we're going to discuss is U.S. government-backed securities. These are loans to the government. Most people think of these as being very safe investments. But when you have something that's very safe, very low risk, also is going to be very low reward. So they're not going to pay you very much money. So what you're doing is you are loaning the U.S. government money and they pay you back interest. So some of the ones that you might be familiar with is T-bills or treasury bills, notes, and bonds. Those are the words. 3 months to 3 years in maturity can be anywhere from 0.25% all the way up to 1.316%. Now what that means in layman's terms is you give the government a buck and they're going to give you back a penny, a little over a penny for a bond. A quarter of a penny, we don't even have that denomination in T-bills, and a note is 1.3 pennies. So in my opinion, I would not do this just simply because I'm looking for a higher return. But if you're looking for something very safe, very low risk, you might consider doing this. Okay, these are your government-backed securities. Again, all that means is you're loaning the government money and they're paying you back. Or we hope that they pay you back.
Something else to keep in mind is these rates will fluctuate. So in certain times, these might be really great investment vehicles, but right now, keep in mind, what's inflation? 3.8% on average. And they're not even giving you 0.25%. So you're losing money. They're making out like a big dog on this if you do this. So right now is not a good time, in my opinion, to be investing in government-backed securities, no matter how safe they are, because it's not even keeping up with inflation.
The next one on our list is banks and financial institutions. You've heard of CDs. Those are certificates of deposits. You've got savings accounts and money market accounts. Again, most people think that these are, in their minds, they're very safe. So the lower the risk, the lower the reward. And what you do is you go to the bank and you put in a CD, a certificate of deposit. You put a certain amount of money in the bank, you let them use it for a certain amount of time, and they guarantee you X amount of interest on that money. And there's a penalty if you want to withdraw it early. So again, if you take a look, this is 0.13%, 0.06%, 0.07%, and this was February. You can Google it at bankrate.com to find out what the latest rates are. But the bottom line is it's extremely low. You can put your money in the bank and you might as well put it under your mattress because these are fractions of pennies, y'all. You give them a buck and they're going to give you fractions of a penny for it all year long. They're not even keeping up with inflation, for goodness sake. They need to at least give you 3.8 cents on every dollar just to keep up with inflation. And they're not even doing that. The next category we're going to look at is the stock market. You might hear stocks, bonds, and mutual funds. Overall, the stock market historically has returned about 10% a year for almost 100 years. The Standard & Poor 500, which is an index group of 500 of the top companies, has returned a little bit more, about 10.5% since its 1957 inception all the way through 2021. You might be wondering what exactly is a stock. That means a company put its company up for sale. They wanted to raise some capital, and they went out and they did what's called an IPO, initial offering, and people bought that stock. That's how initially it usually starts out. So they get their money to operate, and now they have shares of their company available out there to be traded on the stock market. You can have international, global, and US only stocks that you can buy into. You can buy by industry, by different sectors and all different things. And we're going to be going into that a little bit in detail. Main thing here that you need to know is, generally speaking, stock market has averaged about 10% a year. And this is where a lot of your 401ks and all of that are at.
something else that should bring to your attention is, what is a bond? A bond basically is a note. It's a debt instrument. And so when a company issues bonds, it's needing money. And so you give them money, you become their creditor. And you might have heard the term junk bond. That means that it's really, really risky, and the financial institutions probably think it's a really high risk. And so anytime it is a junk bond, if it's a high risk, you better be expecting to get a super high reward. So again, stocks is when you're buying stock in a company. That means you're an owner. You have part ownership in the company, and you can get dividends usually, sometimes, or sometimes you just hold on to the stock. It can split, it can go up. It's very liquid. The stock market is, so you can buy and sell stocks 5 days a week. And the bond market usually works in opposite direction than the stock market does. But bonds are notes and loans where you hope to get paid back plus some interest. Where in the stock market, you hope that it goes up so that you're getting a return on your investment. That's the difference between the stocks and bonds. And mutual funds is just a pool of stock of different companies that you can buy into. So instead of buying, for example, Walt Disney World and Walmart, you might have a mutual fund that has thousands of different companies in there. And that's a way to diversify the portfolio and minimize your risk. We'll get into that a little bit later on when we discuss the stock market.
Next on the list is real estate. We had a big crash in the US back in 2008. They talked about it. It was terrible. Just how terrible was it? The market fell by 30%. And while at first glance you might think that's a lot, one of the things you need to know is it took less than 2 years, and the real estate market rebounded and far exceeded the amounts that it was at before the crash ever even happened. So again, the most it's ever fallen was 30%, not 100%. Unlike some companies who went belly up and they lost everything and then some and went in the hole, real estate, besides some other things such as appreciation and tax benefits, has historically done really well. 4.94% and 4.36% has been the historical averages per year in real estate. And of course, everybody needs a place to live, whether you're buying or renting, and they're not making any more real estate, right? Now, there can be more homes and different types of homes and different categories of structures and all of that stuff, but bottom line is everybody has to have a place to live. And there's some really exciting things happening, especially if you're looking at the senior citizen market. You know, you've got all of these assisted living facilities and different types of facilities coming on board for the baby boomers. So it's big, 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 huge opportunity for us right now in this industry.
Something else that I want to bring to your attention, although it says it fell 30% on average, keep in mind, some areas it did not fall that hard. Some areas it did. That's just an average across the board. That was the most, that was the average. It fell 30% and then it rebounded. So you might have been living in an area where you didn't see that much problem, but in other areas it was really bad, and that 30% really killed a lot of people. Not literally, but financially.
Real estate really happens to be one of my favorite vehicles for building wealth. And I want you to know that there's lots of variety out there in real estate, what you can do. It's not just that you have to think you have to have the money to go and buy a real estate property to rent. That's a lot of money, and a lot of people don't have that kind of cash. There's all different kinds of strategies out there, but some other things that you need to be aware of is there's something called tax lien certificates. There's also tax deeds, and what that is people who get behind and they don't pay their property taxes each year. Well, the governments in each of those counties or whatever it is, they have to have that money in order to operate for their governmental budget. So they auction those off every year, and you can go in and buy somebody's a tax lien certificate, and what that means is you pay off their property taxes that they owe, and they put a lien against that property. And if they don't redeem that lien in a certain amount of time, in some states, you actually would own that property. So it's a pretty cool, interesting thing. And even if that doesn't happen, they have to pay you back what you paid plus an interest rate, and it can be, depending on the state and the county, 16 to 36% interest. Huge, huge amounts of interest that you could get on that. Another one that's really popular that you've probably heard is fix and flips. You can do it yourself. Again, you have to have the money to buy or to, do the fix and flips. Or sometimes you can participate in a platform that does that, and you give them money and then you get a percentage. Another one is Airbnb rental arbitrage. You actually don't even own the properties, yet you acquire that property through a lease, and then you rent it out through Airbnb or something like that, and you keep the amount of money or the spread. For example, if there was a property, I live right here in Northwest Florida, so we're in a tourist area, and I could get a hold of a house and lease it from someone that owns it, and let's just say I'm leasing it for $1,500 a month. And I tell them what my plan is, that I'm wanting to put it on Airbnb and rent it out. Well, I'm on the hook for them for $1,500 a month, but I'm going to put it on Airbnb for $1,500 a week. And as long as I pay them their $1,500 a month and keep the bills paid and don't tear up the property, I get to keep all the rest of it. That's what rental arbitrage is. So it's a very exciting option for some people. Another one of my favorite investment vehicles is business opportunities. If you get the chance, make sure that you watch the virtual reality show Shark Tank. It's a panel of very wealthy individuals. Some of them are in the Billionaires Boys Club, and they're up there on a panel, and entrepreneurs come and pitch their business idea or their products to this group in hopes of getting funding. And these are called angel investors, venture capitalists, all those things. And know that this is a high risk category. But when you have high risk comes high reward. On average, they expect at least 25%. Some of them want a piece of your business. Some of them take over your business. Another show that you might could watch was The Prophet. That was on also. He would go in and clean up and fix these businesses that were in distress. And those are two of my favorites that I love that has to do with entrepreneurship. So if you're an angel investor or venture capitalist, know that you are going to be vetting a lot of these businesses, and you're going to be taking on a high risk proposition for the hopes of getting a big payday. And there are some that's done extremely well in this area. So what you need to know here, high risk, high rewards are possible. The average is about 25% a year what they would get. Next category on the list is precious metals. You might know these best by gold and silver. Let's take a look at gold. And I just pulled this the other day. So in 20 years, gold has went up 450% over 20 years. 5 years, 36.75%. So this is how gold has performed. One of the negative things about gold is it's heavy. How do you transport it? There's been all different kinds of business opportunities and different ways and things that you can get involved in gold. So don't let that deter you. This might be something that you would be interested in, because overall, take a look at that. You want to figure out what that is on average. Take 450, divide it by 20 years, and you would get that's 22, a little over 22% a year. Not bad if you're into that. Next category on the list is precious metals. You might Next on the list is silver. You can look at the 20-year rate for silver, and it is up 372.28% over 20 years. Now, historically, it hadn't done quite as well as gold, but it has still done extremely well. One reason why people like silver over gold is the price. The price is a lot cheaper to and easier to get into silver than it is to gold. There's a lot of business opportunities available for you to buy the gold and silver if that's your thing. One of the things that is a con is it's heavy, and how do you transport it, and how do you do this, and how do you do that, unlike some of the other investment vehicles. But this might be something that you want to look at to put in your portfolio, because after all, we want to be diversified. You don't want to have all your eggs in one basket, because if something happens to one of these categories, you want to be protected. Next on the list is commodities. You're talking agricultural, raw materials, beans, rice, that type of coal, fuel, energy, and your precious metals, all those different things. And one thing to keep in mind is these can be worldwide, so not just in your particular country, but things that happen all over the world can affect these commodities. Right now in the United States, as well as everywhere else, we have transportation issues. With COVID and everything else going on, people couldn't get the goods and services coming in. And then when you got that issue, along comes the railhead, the problems with getting it transported into the country. Then on top of that, you might have getting it down the rivers. Our Mississippi River is drying up here in the United States, and that's a big area for us to move goods and services. So, you've got the train. So another one would be your truck drivers. We got fuel, having a diesel issue right now, and truck drivers having to move goods and services. So all these things fit into this piece of puzzle, which makes it volatile, but it also makes it a good opportunity to make some good money. In fact, our group, we're in most of these categories that you'll soon learn more about.
Something else, just to give you an idea of the trickle effect or the domino effect, I guess I should say, is when COVID happened, all of these ports, especially the one there in California, they were having a terrible time. So those barges were sitting outside of California months and months and months, and they had goods and services. So if you went into your stores like Walmart or even some of any store really, and you looked on their shelves, a lot of stores are empty. They couldn't get their goods and services because they was buying them. We were talking the import export situation. We was getting so many goods and services overseas. We was bringing them in from other countries outside, and so our shelves were empty. Well, the domino effect is if businesses in America can't get goods and services to sell to their customers, what happens? They don't have anything to sell. They're liable to go out of business. It was terrible. It continues to be terrible. I still see shelves that are empty. And, they've tried to transition and start doing more inside the United States, and probably other countries are trying to do the same. But when you rely on goods and services outside your country and you have a situation, it can be a real problem. And I say that because think about those companies who have stock out on the stock market. So you might have tanked. You hear about the stock market and all these different things. Well, these companies, otherwise, they're fantastic companies, but that was something that was outside their control, really, and caused them a financial hardship. So their bottom line could have been severely affected.
Last but not least is a very exciting category called fintech. And you probably are familiar with this, been hearing it on the news. You might be hearing Forex, crypto, Bitcoin, NFTs, all of these little buzzwords, and may not have a clue what any of it means, or you might have a clue and it scares you half to death. So I just want to give you a little overview right quick. Forex stands for foreign exchange, and crypto stands for cryptocurrency. Those are two totally different animals. And let me explain the difference, because a lot of people think they're the same. Foreign exchange stands for foreign exchange currency. For example, all over the world, every country has its own currency that it uses for people to buy and sell goods and services. In the US, we have the US dollar. Canada has the Canadian dollar. In Mexico, they might have the Mexican peso. In Europe, they have the euro. So as long as there are different currencies being exchanged all over the world, there's going to be a market for Forex. And it's doing extremely well right now. In fact, we've got an amazing platform right now that in 7 months we're up about 350% on our money just in foreign exchange alone trading. And what they do is they've got these platforms that are out here all day long trying, and it's 5 days a week. It's not seven. It's 5 days a week. They are trading. For example, they might be buying US dollars and trading them for euros, depending on all the different things that's going on in the world. They do that and they're making money off of it. It's a different type of arbitrage. Next is cryptocurrency. That's your digital assets. That's where you're going to hear Bitcoin, Ethereum, your non-fungible tokens, all of these digital assets. And a lot of people are scared to death. They made a lot of money. They've also lost a lot of money. It's very volatile. It's very high risk, but there's a lot of potential out there as well. In fact, I got involved by accident, even though I'd been looking into it. Folks, this is not new. This has been going on for, 10, 20 years. It's just now being brought to the main out there in the news where it's become mainstream. But this is not new. They've been working on this stuff for a while. So back in 2020, I'd been kind of dabbling, not really. I wanted to do it, just didn't have spend the time to do it. I had asked for a refund, and this company sent me back an email and said, "I'll be happy to give you that refund, but it's going to have to be in Bitcoin." And I thought, you know what? No problem with me. I want the refund. Give it to me in Bitcoin. I did the research, and it just sat there for a few months. During this time was the big bull run on Bitcoin where it went up so high in price. Hadn't looked at it in months. Started following the news, and I thought, let me go in there and check that account. Well, just through the appreciation alone, I had enough that I was able to buy my whole entire Christmas in 2020 just off of that Bitcoin appreciation. So that made me a believer, absolutely, and I'm very excited about what the future holds in this fintech space. And I think you will be too. Part three of our presentation today is PIG membership. This is our passive income generators, our wealth builders club for entrepreneurs. I'll be giving you a little bit of background on how we got started. I'll share with you one of our favorite projects and show you our weekly PIG report, showing our results that we've gotten on this little project. I'll also give you week by week topics that we cover on our Lunch and Learn Zoom Friday events every Friday at 11:30. And last but not least, I'll go over our membership pricing structure. It's very affordable. Kind of want to give you a little background of how this all started. I've got a group of entrepreneurs from around the world, and we've been working together over 2 years, about 2.5 years now, and it's been wonderful. It's a group of entrepreneurs from all different backgrounds, all different age groups, and there's some interesting characteristics about this group. We all want to make a positive impact. We're all interested in building wealth. We want to do good things, and we're all entrepreneurs. We have our own businesses that we run and operate, and we're interested in helping one another rise higher, go further, faster. So we've been meeting together every Friday for about 2.5 years. And another commonality that I found was everybody wanted to be investors. And so they were investing in different type projects and come back and telling us about it. It was all exciting. Well, one of the ideas that I'd had for quite some time, and I had launched it back in 2009, was like a Shark Tank type situation where we would be funding startups or entrepreneurs, because that's where my heart is, entrepreneurship. And what ended up happening was a little bit different than that. When I saw the possibilities out here on these digital platforms and how we could be making money around the globe, we decided that we were going to launch what we called a co-op. So collectively, we would get together every 90 days and we would pitch in a few bucks, 30, 50, or 100 bucks, and we would vote on what projects that we wanted to vet and test out with our money. And then 85% of any of that would go back to the members as a revenue sharing royalty reward. So it was similar, very similar to what an investment club would be without all the red tape and restrictions and all of that stuff. And so what you could do after the results were published would, figure out whether you want to do that on your own or you just wanted to continue on with the group. And we started out in the fintech industry doing some foreign exchange, crypto, and different things like that. And since then, we have added the whole spectrum of different investment vehicles. We all want to learn. We have different risk tolerance levels. We have different income levels. And so this has become just a wonderful, wonderful platform for us. And we changed the name so it would be its own separate thing this past year. And now we are known as Passive Income Generators. We're a wealth building club. And that's what I'm going to tell you about here next. This is one of our examples. Each week I give a weekly pig report depending on what type of project it is that we have our money invested in. And this is one of our little darlings. This one has been consistent for several years now. Just absolutely love it. And right now we have $3,079 that we've put in this platform. This last week, as of November 27th, we made $191.45. $48 was commission. Trading profits was $143.44. We have a balance of $5,110 after that week, and we had a return that week of 6.2%. And overall, we're at 166%. Now, this particular one, when we get to 100%, we cash out. We always keep that 3,079 in. So we've already cashed out one time on this account, and now we're up 66% more. We're going to do another cash out in January. But anyway, this just gives you an idea what we consider good right now, like really good. We're real pleased. If something can give us, 2.5 to 3% a week, for us is stellar. And as you can see, this one has performing consistently well over that at 6.2%. And overall, just the trading component, I think, is at 2.85%. And this is the one that I encourage everyone. If when they ask me which one would you, I'm not a financial planner, I'm not a financial advisor. But if you was to ask me if it was your money, Nancy, where would you put your money first? It would be into this particular platform. I love it that much, and it's shown consistent results week after week. You can pull your money out easy without any trouble. And on this one, we started January 6, 2022. And then I want to tell you about this one client that I have that I'm handling her account. She started in July of this year. She already is at 68% ROI, and she will be at 100% projected by February 2023. Of course, there's no guarantees of income. They're, expressed or implied. All I do is we vet these projects. We use real money. We put them inside our projects, the PIG group does, and then I report and publish our results. If we make money, 85% of that is distributed equitably among the members. What good is that, you say? Well, it can really add up to be some substantial money, and possibility you can get your membership fee paid for free. Make sense? So why wouldn't you want to do it? So it's been a no-brainer for a lot of us. We've had a lot of fun. Again, that's just an option if you would like to join us. Again, if you'd like to learn more, you can get with me, and I'll be more than happy to set up a one-on-one where we can talk a little bit more about what you got going on. For our passive income generators, we're aspiring, emerging, and seasoned entrepreneurs around the globe who desire to. Again, these are our commonalities, some of the things that we're working towards as a passive income generator. See if you don't find yourself in some of these categories. We're available to leverage our skill sets, tools, and resources to create, fund, and live lives worth smiling and talking about. Remember, I told you we're heart-centered entrepreneurs. We want to make a positive impact with our life, but we want to make a generational impact. We want our legacy to not just end when we die. We want it to continue on for years to come. We're interested in building multiple streams of passive income. We also want to achieve financial independence in 5 years or less. We don't have 20, 30, 40 years, most of us, to build a legacy. So we're out here looking for platforms and ways that we can speed up that process as much as possible. Again, we have an earn as you learn component. So as we meet, we're learning and we're earning. And 85% of any revenue that's generated is set aside as a revenue sharing royalty reward and distributed equally among the members. Now, this is how this program works. Every week we've got a different theme. Week 1, we do networking, elevator pitch practice. We work on collaborations with one another. Basically, we want to do business with each other. The best thing that you can do, not everybody that you meet is going to do business with you, but everybody that you meet should be a referral partner. Think about everybody that's your friends, family, neighbors, and all of that. Do they know what you do for a living? Have they ever sent you a referral? Look at your phone. How many contacts do you have in social media? This is one of the things that just kills me. A lot of people, you don't need to know any more people. You have a really nice circle of influence. You're just not leveraging it and as you should. So week 2, we do mastermind sessions. This is where you can bring in any entrepreneurial problems. We share tips, tools, and resources with one another. Again, we're people from all over the world with different experiences, education level, income brackets, ages. We're all different. So it's iron sharpens iron. Week 3, this is all about wealth building, philanthropy, and business opportunities. Week 4, personal and professional development. If you're not growing, you're dying. So no matter what your age is, you should never stop learning, right? There's always something new to learn. So if you've got a special skill or expertise, get with me. We'd love to have you to come in, schedule a time where you can give us a session and share your expertise with the group. Now, you may or may not be an entrepreneur. And everybody in this group that meets on this weekly basis is an entrepreneur or they aspire to become one. They're somewhere in that process that they want to own and operate their own business of some sort. They may or may not know what that even is. And we can also kind of help you get started with that as well. So that's what that group is. You're here today because you are in the easy peasy affordable investing strategy class, and that ties into week 3. I really want to get more people, especially women, off the fear train and into taking care of their personal finances. It's easier than you think. It takes way less money than you think. The main thing that I have to tell you, and I can't stress it enough, is you just have to get started. It doesn't matter whether it's, like I said, pennies, nickels, dimes, and quarters, because they all add up to dollars. So if you would like to learn more about joining our pig group, you're more than welcome to do so. You can get with me and schedule a one-on-one where we can talk about it. Again, it's very affordable. It's very affordable. I make everything I do affordable. Everyday people can afford. If you can afford $1 a day, you can afford to join the passive income generators.
So here's the membership. We offer membership 2 times a year at this price, $125 a year plus $30 a month. And that includes the 85% revenue sharing royalty rewards program. So you get every week the Lunch and Learn Zoom Fridays, which includes the masterminds, the networking, the wealth builders, everything for this price. No brainer.
Okay, so we're at the end of our orientation for easy peasy, affordable investment strategies for everyday people. You might be wondering what's next. Well, you have a choice to make. Would you like to start joining us in for our class every Tuesday at 11:30 on Zoom? Keep in mind, for those who can't attend every time, I will have the audio and the video recorded. It is important for you to attend, however, because iron sharpens iron. And the more people that we have participating, the more robust and rich the discussions will be, and I'll be able to help you more one-on-one. We want to help you get started. I want to get you over your fear factor. You don't have to know anything to come in here and join the class. We're going to start right where you are. We're going to be discussing platforms. We're going to be discussing game plans. Anything that it takes to get you started and get you over that fear factor so that you can become an investor and a philanthropist on the way to achieving financial freedom in 5 years or less. You can attend one time for free, and then you have to start paying for your classes. I've got a bunch of different options available. I want to make it affordable. For example, you can buy one for 20 bucks. You can buy three for less than that. I believe it's $50, and then all the way up to you can get some tickets for $10 each. So the more you buy, the cheaper it gets. The other option is if you decide that you want to join passive income generators, you can get the classes for free. So that may be an option as well. So at this point, I would like to invite you to join me for a 15-minute meet and greet one-on-one so that I can get to know your situation a little bit better to see how we might bring value to one another. And again, if this is not for you, it's fine. Maybe it might be for somebody that you know. So I would appreciate any referrals. And again, this is a no high pressure, no obligation opportunity for you. My goal is to coach you and to get you ready to take the next step, whatever that next step is. Again, I don't expect you to have a lot of money. Some of you will have more than others. We're going to be coming from all different backgrounds all over the world. And I want everybody that comes into this to be very comfortable. And again, it's all about getting rid of the fear and start becoming financially literate. That's important. The report card, set up your goals, figure out your game plans, and just put yourself on a wonderful, positive financial trajectory for generations to come. Again, my name is Nancy Gaskins, sowing seeds of financial hope and entrepreneurial opportunity in communities around the globe.
To schedule an appointment with me, you can type in your browser itraininvestors.com. That's itraininvestors.com. Thank you.